Welcome back, everyone. It is month 42, and of course, that means it's time to buy more stocks. We are the Dividend Dudes. We have Tom here for this one.
Yes, you do. You have Tom. You don't always have Tom, but when you have Tom, it's great. Everybody loves Tom. Nobody does Tom like Tom does Tom. Tom is the best Tom of the Toms that are Tom.
But you'll have me for a single stock video coming up.
So we've been doing this for 3.5 years now, starting from zero. Now, if you're somebody who's new to finance and you're trying to figure out how do I get a six-figure portfolio like we have, you're in the right place, because we literally started from zero. And we have, in this entire channel, have every video, a monthly video rather, where we show you what we purchase every month and how we went from zero to six figures. So if you want to know how we did it, you don't need a lot of money to get started, you're in the right place. And we're going to show you what we did for this month, month 42, 3.5 years. It doesn't feel like 3.5 years. That's the problem with time, is that when you start investing, is you think, oh, well, I put this money into this company and you know, it's not going to do anything, but then time happens and all of a sudden you're up like a lot.
Set it and forget it. And when you're having as much fun as we're having, time just flies.
For this month, we have a bit of a problem. We've been talking about this for a while. Every time the market goes up, Brian thinks this is funny. I get a little stressed out because I don't know what to buy.
Yeah, but it's fun because it's, oh my God, look at all the money we made. This is terrible.
Yeah, like for example, Intel stock. We've been talking about Intel for months and months and months and months, and it went up, and I got mad, and Brian's like, you're the only person, what'd you say? Like, I'm the only person that you know that gets mad when stocks do well?
Yeah, well, yeah, you get mad at all the money you made. It's like, I was hoping I wasn't going to make this money till later.
So in respect to the portfolio, we have just over 20 stocks in the portfolio. And when we were starting this, it was $400 a month. And some of you who have been watching our channel for a while now know that we covered these same things over and over again, and it's somewhat boring. And if you watch some of our past videos, you'll hear this again. Mm-hmm. Why?
It's important. This is the foundation of your portfolio, your investment journey. It's what gets you there. So if we say it every video, we're going to say it every video.
That's the point of this, is that the things that get you to six figures and beyond, if we got to six figures with what we have now, we're going to very easily surpass that later on. It's repeatable. It's kind of a boring thing, and it's not that exciting. What becomes difficult, though, is when the market is priced really high like it is now, there's not a lot of opportunities. If you look at some of the stocks in our portfolio, you're going to see that there's a lot of really big gains there, and it's really hard for me not to sell for profit, by the way, but you're going to see some pretty big gains there. Now, the company has to actually match the performance financially to justify those gains. So when the market goes up, Tom gets fearful. I actually do wonder, like, okay, what am I gonna buy? So for this month, we were more about cost basis and the underlying company than we were about, hey, let's grab that next big opportunity like 3M or Intel or any of the other ones like Comerica and Honda, like we sold Honda stock recently. And again, if you're wondering how the portfolio got to where it is today, all you have to do is look at past videos. You can see that the gains are not just from us putting money in the portfolio. We sold some stocks. We got a lot of dividends. We made some profit on the sale of those stocks. We've done quite well, but this is the process of doing this is kind of like balancing a checkbook. It's just something you do every month, and it's something that's very repeatable.
What are you talking about? People don't balance their checkbooks anymore. Who does that? Put it in the comments. Does anybody balance their checkbook recently?
Okay, it's like running month end if you're a super fancy business owner like I am.
I think this really begs the question, when the market is up and there aren't any good companies that are beat up that you could buy as a bargain, and you also have a fully diversified portfolio that has 20 to 30 stocks in it, and you don't really want to buy more to, risk making an index fund, what do you do with that $400 a month or however much you have to spend?
You buy things.
You buy projectors and
cars and TVs. No. Actually, well, yeah, okay.
You do, but you shouldn't.
You shouldn't. You should not. When it gets to that point, there's something called dollar cost averaging, and that's basically what you do. And what we did this month in the portfolio is we looked for, in our stocks, you'll notice quite a few of them are doing well, but there's a few of them that are not doing well. We still believe in the underlying business because the thesis is buying companies that produce valuable services or products that people either have to have or they really, really, really want them. And in this case, we had to find a few businesses that were not doing well relative to the rest of the stocks in our portfolio, and we found a few. And for next month, month 43, it's going to be one heck of a journey unless the market crashes, because it's getting worse. So what we did is we sorted the stocks in our portfolio by cost basis. We found the ones that were low that were also not doing well. And then what we did is we went into, again, the boring stuff that a lot of people don't care about, but we went into the financial statements. Mm-hmm. We looked at their earnings reports. We looked at their cash flow. We looked at the kind of debt, how leveraged they were. We looked at all the numbers, kind of like I said, you're balancing your checkbook, or you're basically building a budget. We looked at their budget. And what we came up with was a few companies this month that looked pretty good to try to bring us back up to that level. Unfortunately, when the market's really highly priced, this is about all that you can do, because there is an ebb and flow to the market. And if you go and you look at traditionally stable companies, you'll see that every few months, it's usually about once a quarter. And if you're wondering why it's once a quarter, well, it's their financial reports. I mean, they have financial reports, they come out, the stock adjusts based on those reports. And about every quarter, you'll see the stock do this. And it's almost every company in the whole stock market does
Sometimes
this.
it's big swings, but a lot of times with like the companies that we choose, it's little waves, but you want to get it on the down wave, right?
Yeah, and that we're trying to find the ebb of that. With that said, the stocks that like stood out to us this month, one of them is a growth stock, and we're trying to find the diamond in the rough with the growth stock. The other ones was, and this is going to be again like, why is this exciting? We bought Kimberly-Clark this month. We bought quite a bit of Kimberly-Clark because we had a fixed income security that came to maturity and we had to put the money somewhere. So when I looked at, with Brian, the interest rates that bonds and CDs were pulling, they were pulling less than 4%. I think that has increased over the past few weeks. It's gone back up over 4%. And then Kimberly-Clark was doing really poorly. If you look at their year to date, look at 2 year, look at 3 year, look at how they were doing. They're doing really poorly in the portfolio overall. So we just threw that money into that stock to increase our portfolio income. We also added to 2 other stocks that we had been looking at the past few months, UPS and Devon Energy. We know Devon's cyclical. We want to be taking a look at that energy industry. Boy, I can say that right. Energy industry as the tariffs and the current administration's policies affect the energy sector, because we have a feeling that companies like maybe ExxonMobil might benefit from that. Don't quote us on that. We're not sure yet. So we're going to be looking at that for next month. But what we tried to do is we tried to average out the cost basis, and Intel, you're too soon. But no, if you look at Intel, it's now, we haven't added to it, but it's now 14% of our portfolio, which we believed at the time when they were trading at their book value that they would be 15 times that to get to the average of the energy sector, or not energy, the tech sector, the energy sector.
And they're up 50% in our portfolio. So
that's going to be, when we talk cost basis, that's going to be kind of fun to figure out how to level that out.
If they get up to 80% or 100% gain, then we might even sell it. Who knows? But I doubt it.
Yeah, Intel's historically like a dog of the Dow. They're mostly an industrial stock, so they probably will start paying a dividend at some point. And when they do, it's going to be really difficult for us to sell them, just because those will be qualified dividends. They're not taxed the same way like an ETF is. If you don't have a financial advisor and want to know those differences, talk to them. They will get you through that. But for this month, we added to the UPS because they were down relative to what we had purchased, and the cost basis played a part. We bought Devon because of the cyclical nature of the industry. Energy. Yeah, we bought the energy company called Devon. Yeah, so we bought a little bit to them. And then we also added to Rumble stock. We feel there is an opportunity there. And for people who look at financial statements and you're looking at their financial statements, you're probably looking at that going, what do they see in this company?
What are you talking about?
What you talking about?
They have not made a profit yet.
We see something there. But if you'll notice, we've only been buying Rumble stock from the same thing we've told everybody every other month. We're buying it from the proceeds of dividend checks that we get every single month. And by the way, we're at like Honda Civic level. We made it.
Yeah.
I can buy a Honda Civic.
We're going to have to up our target there for, maybe in a Accord or something.
If you go back to past videos, you're going to see this. We make jokes about like, oh, you can get a horsey ride at Walmart or something. So this is the foundation that we talked about 3.5 years ago when we started this. If you're starting out with zero and you got $400 or even like $100, you got nothing to invest. If you go back and look at some of our live streams, we talk about that. I had nothing. I lived in a Geo Metro.
But it grows over time.
Not the Geo. The Geo
Not
doesn't
the
grow.
Geo
The
just
Geo
dies.
It stays tiny.
Yeah.
But it grows. So the money that you put into this early on, it doesn't take that long. And now we're getting, whether the market goes up, it flows, or it goes down, it ebbs back. We're still going to get $300 a month. That's amazing. So if you needed and think about the businesses that are in this portfolio. If you look at the stocks that are here, I'm pretty sure Procter & Gamble and Johnson & Johnson, these other companies that make things like bath soap and Kimberly-Clark, toilet paper,
yeah,
they're not going to go anywhere. Even if you're like in Japan and everybody's got a bidet, you still need to wipe your, I can't say it.
Derriere.
Yeah. Your detrás.
Your poop hole.
Ooh. Ooh. So that money, we're relatively certain on a monthly basis, is pretty secure. And you'll notice it's up over $290 a month now. We're using that money to purchase Rumble. And we believe that Rumble will be a good growth stock. We think that social media there needs to be both sides of the argument here. The left needs a voice, the right needs a voice, and hopefully between the two, we'll come to the middle, because most everybody sits somewhere in the middle.
We need a center voice.
Yep, and that's one of the reasons why we bought that. But again, in the portfolio, if you look at this and you want to know how you can do this, there's a couple things that you can do. Number one,
we are not your financial advisors. We recommend that you get a financial advisor. Nothing we say can be construed as financial advice. Thank you very much.
Okay, actually, number one, what would they do?
Wait, what? Go back.
Okay, well, Brian did say it, but like he meant like get a financial advisor was his thing. And that's true. You need somebody who's like better off financially than you that does this for a living to do that. So get that, figure that out. Number two,
pay all your bills.
Survey says!
If you're not paying your bills, you're probably in the wrong place.
pay off all your debt and your credit cards and your loans.
Yep, there is a thing with credit cards that their interest rate is like 21, 22, 25, 9,000% interest, where a dividend check from Kimberly-Clark, or even our annual compound growth is from 2023 is like 20% per year. And you can see that here. Future Brian, you can insert yourself here and criticize me all you want. Be gentle. I wound easily.
He does. He bruises very easily.
But if you look at the 20% there, even that 20% growth that we've been compounding annually, it does not match what a credit card interest is on the card itself.
Right.
So pay that stuff down, live below your means. So that'd be the second thing.
Number three?
Number three. Well, number three. You're gonna make me do
buy a bottle from TDDstore.com. No.
How does that help us?
It helps us.
Buy a bottle, I guess. Bye.
Anyway, number three is after you have paid down your bills.
This is off the cuff. There's no script here. Come on, Brian. You got it.
Number three is to put into your company 401k if they match, or the HSA if they have that.
This is why we tell you about financial advisors. There are taxes that people have to pay when they have jobs, and things like 401ks and Roths and HSAs and all of that. Those are tax deferred. And that gets me on another tangent, which I will not, I promise, I will not get too far into this. Stocks that you hold for longer than a year, if they're the right kind of stock, not like an ETF, will be taxed at ordinary income rates. A stock like Johnson & Johnson, Campbell Soup, anyone that pays a dividend that you've had for more than a year will be taxed at a qualified dividend rate. REITs are not qualified, just so you know. There's a huge difference that adds up over a long period of time. Now, this is different if your portfolio is a Roth, which is why I promised Brian I would not get into all of this.
That's another video altogether.
That's a whole other video.
Another hour or 2 hour video.
The point here is that you need to make sure that you're taking the resources that you have and spending as much as you can, even if it's like $50 in the right places so that the gains are bigger later. And if you look at this portfolio, and if you want to see, well, what does this look like in 25 years? Our portfolio is averaging 20% per year. You can see it. If you take that out, it doubles every 5 years. If we do nothing else, and I take this out 25 years, so next 5 years, it's 200,000. Next 5, and this is me not doing anything else. We're not touching this portfolio at all. It's worth about $3.2 million by the time I'm in my mid-60s. Yeah, but Tom, inflation. Right. That's still $3.2 million if you do nothing. So the dividend snowball, all of this is real. So we're trying to help you with understanding that the little bits that you throw in when you're younger make a huge difference. Even if you're like older than we are and you're like, well, how do I start? If you're making $290 a month in dividend checks, that helps.
Yeah, if you get a Honda Civic and you could pay that entirely just with dividend checks, that's basically a free car.
The important thing that we're trying to get at is step number, what are we on? Four. Step number 4. What is step number 4?
Buy a Porsche. No. What is that? Okay, so we paid off all our debt. We are investing in our HSA and 401k.
We live below our means.
We're living below our means. And 4 would be, after that, get a financial advisor.
Well, that was step 2.
Step 2?
4 is get started.
IRA?
Get started. Just start. Open up a Robinhood, a Schwab account, a Fidelity, something, and just start. Yeah. Even if you think that, like, I can't afford this, we've got a stream where I'm talking about I didn't have money to replace the brakes in my car, which is a true story, and I put $100 in the market. Thank God I did that. Just find a few dollars here and there, work extra, just get started. The market, there's a lot of greed in the stock market. There's a lot of people who will try to get you to day trade and option trade. And I would say bypass all that, just get started. And that brings me to the next step, which is
don't stop.
Don't stop. Actually, I would say it would probably be for me, just don't get caught up in the greed.
Yeah.
Don't get caught up in the cycles. Don't get caught up in options. Don't get caught up in day trading. If you want to look, you can use AI if you want. You can look at the IRS reports on how many people actually make money doing crypto, doing day trading, doing all of this. It's very, 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 very tiny percentage of people that actually make any money in the market. And that was my real voice. I should be a voice actor.
You should. So basically, once you have your foundational stocks and you are making dividends from that, use the dividends. If you want to do any of those type of day trading things, use it on the house money. And that's the dividends. So if you're going to gamble, you might as well gamble with the house's money.
And that's what we're doing with our Rumble stock purchase. Like, we believe that that's a good investment, but if it doesn't pan out and we're proving that, well, Tom and Brian, they made some pretty dumb decisions. Well, okay, yeah, but the rest is fine.
Right.
The principal is going to be just fine.
We're going to get dividends to replace that money. So.
Right. And that's, like I said, $300 a month is not a lot, but it's nothing to sneeze at either.
Yep.
So if you're looking at trying to do this, start small. And I would say the last step of this, if you're just trying to figure this out, watch our past videos. You'll kind of get in our heads a little bit and you'll figure out the way we do this. It's going to take some repetition. It's going to take some learning. But I would also say accept and embrace the small wins. Hey, I made another $5 a month in dividends. Embrace that mindset, because when you get to the really big numbers, it doesn't phase you as much because you're thinking, well, no, the market, because when the market crashes, it crashes on average 40%. So imagine this portfolio, $100,000 portfolio, going down to $60,000. What would you do? Would you think, oh, I'm going to sell everything? Oh my God, I can't do it. Or would you trust that the companies that you invested in are doing well? They have got good balance sheets, they produce products that people have to have, and that those dividend checks that you're getting that are mostly tax-free, and for most people they will be, or at least very low taxes, are going to do okay. And would you see that as an opportunity?
Yeah, those are still coming in. You could still use those if you need it to live on, because if it's gone down 40%, then cost of living is probably astronomical and your living conditions are probably worse than they were before. So if you need that to live on, use it. But you could just use that. Now the stocks are down and they're on sale, to buy more stocks. That's the opportune moment to buy.
That's why I get mad when they go up and kind of disappointed, or excited rather, when they go down.
Right. Yeah. Yeah. It's nice to make that profit, but it's also nice to find stocks that are on sale and on fire to buy, so that you get even more profit later on. And that's really one of the difference between a growth and a dividend portfolio, is when it goes down 60% or 40%. A growth portfolio is out that money. I mean, if you're living on that money, you're in trouble. $40,000 less to live on, right?
Right.
So,
and that's, I guess that's kind of the thesis behind the whole portfolio. And like, I don't get stressed about this at all. I know the market's overvalued. We're dollar cost averaging. We're going to be just fine. And we're hoping that you will be too. So accept those small gains. And if you found this helpful, please comment, please like. We really appreciate that. YouTube is not spreading this channel very much. We wish they kind of would. But at the same time, if it helps you, that helps us continue to do this, because we are doing this for you.
Engagement.
Yep, engagement. That's a thing. Imagine that. And then from this point forward, just if you've got a stock or a question, we're happy to at least try to answer those questions. Put it in the comments, send us a message, and we'll try to help you out as best we can.
Yep. And look for the single stock Rumble video coming out hopefully soon.
And with that, this is totally unscripted, so there might be a few outtakes at the end of this.
It's going to be a bear to edit.
I hope not. Again, I'm always so good on video.
These unscripted ones are terrible to edit.
No, I'm so good on camera. It's amazing. They're going to love this, Brian. They're going to love Tom.
Maybe I won't edit it at all. I'll just leave it as is.
With that, oh boy.
Good luck, and as always,
happy investing.